or voice note.
Message us at 925-3261 on WhatsApp today and get active with Radio Cayman.
Radio Cayman, the voice of the Cayman Islands.
Radio Cayman, maintaining the innovation.
Live from Radio Cayman Studio, this is
Money Sense, bringing an informed financial perspective to the Cayman community.
A very good morning and warm welcome once again to Money Sense. I'm Simon Cawdery and I'm delighted to be joined on Money Sense this morning by Jessica Jablonowski. Jessica is a CFA charter holder and the Managing Director at Radix Financial Cayman, which is a CIMA registered investment management company operating right here in the Cayman Islands. Jessica, first of all, welcome. Secondly, thank you for joining us. And thirdly, you're being very brave joining me discussing markets and such like. The interrogation is about to commence.
Let's get it started.
Yes. Well, before we do, actually, there will be a lot of people who will be listening to this who will say, Radix, not heard of them. Perhaps you just give us the sort of 1 minute summary as to who, what, why, where, which, and any other adjectives I can think of.
Sure. So Radix is an independent investment advisory firm here in Cayman. We manage money predominantly for individuals and families. We focus on long-term growth and financial planning. Our philosophy is really simple. We think that investing should be effortless for clients. That means no gimmicks, no sales pitch, just well-diversified portfolios designed to navigate through different economic environments. And we also run the Radix First Pillar Fund, which we call the Easy Button for investing. And we're committed to financial literacy in the community. So we've done some partnerships with schools. And then we've created some parent reading guides that kind of make it easy for parents to start having these conversations with their kids from a pretty early age.
And that's a topic we're going to come to, I think, probably in the second half of the show, financial literacy, because it's a topic that I know is close to your heart. And it's something I think a lot of listeners will find quite or relate to. But we are in a world of, I don't know how to describe the world other than, well, let's leave it undescribable. In order to lead into this, we live in a somewhat challenging environment, challenging world. Markets are a little bit tempestuous, and nothing perhaps more tempestuous than the current debate about should interest rates go up, should interest rates go down, and we might park this one, but should the Fed chair still be there? Should other Federal Reserve members still be there? Perhaps before we talk about interest rates, perhaps we talk about that, just give us a bit of history about the Federal Reserve. What exactly is it? Because I think sometimes we talk about interest rates without going back to first principles and talking about what is a central bank and what's its purpose.
Yeah, sure. So the Federal Reserve really has two mandates. They call it their dual mandates, and it's a balancing act for them, trying to kind of fulfill both of those. So on the one hand, they're trying to ensure that there is enough kind of job security and job growth. So they're focused on the labor market, and they want to make sure that the U.S. has full employment. And then on the other hand, they're focused on making sure inflation stays at their target rate, which is currently 2%. So that means, prices of goods are not increasing higher and higher over time. And they are using interest rates, they're setting rates to kind of, it's an imprecise tool really to try and fix, the complicities of the economic environment. But basically, if, unemployment starts to go up, they can cut rates in order to stimulate the economy, stimulate more spending, and try and get the economy to grow more. And when prices start to go up too much, they can raise rates to try and slow things down and prevent further price increases from there.
And I imagine there'll be a lot of people who will listen to that and go, I've heard that before. But talk to me about the mechanism. Why do interest rates relate to employment? Why do interest rates relate to prices? There's obviously, there must be a mechanism. So let's just explain that one for us a little bit more. Yeah,
sure. So really, kind of the Fed rate sets borrowing rates kind of across the board for everyone. So why does this matter? To me, we kind of think about that. This is kind of the basis for all of your financial decisions. So, mortgage rates on your credit cards, you need to get a car loan. All of these things are impacted by what the Fed is doing with rates. And here in Cayman, why do we care about what's happening in the U.S.? Well, Cayman dollar is pegged to the US dollar, therefore we are inherently kind of importing that interest rate policy from the US because we follow the, mortgage rates here in Cayman also follow what's happening in the US.
I guess because a bank here, if it's got surplus cash or if it wants to borrow money in order to lend to its consumers, it has to go into the US dollar market in order to borrow. And that's, as you say, linked intrinsically and explicitly by the fact that we have the currency peg because of that. So one of the things I think people look at and go, okay, well, so interest rates move in the US. Banks in the US sort of respond, they do things, they change their borrowing rates, they change their lending rates. And the same sort of thing happens in Cayman. But the Cayman market for, say, mortgages is not necessarily identical to that in the US. So you often see different changes or different speeds of changes in one country versus another. And that's the same in other parts of the world as well. So why is that? Why do we sometimes see faster changes in one country or slower changes in one country and more impact on consumers in other countries versus what sometimes happens in Cayman?
Yeah, I mean, Cayman obviously is going to kind of, from an interest rate perspective, follow fairly closely to what's happening in the U.S. The banks adjust rates, pretty quickly within a month or so after rates move in the U.S. Other parts of the world, every country kind of, has their own central bank, and they have their own labor markets, their own policies that they are deciding on and influencing, so we can see differences obviously amongst various countries. Cayman is just inherently tied to the US, like we mentioned.
But in the US, I'm trying to recall, you often don't see people quite so nervous or excited when interest rates fall, because often they're on fixed term mortgages, and whereas in Cayman, an interest rate move that goes up, it's everyone lets out a collective groan and go, oh, that's bad news. But equally, when interest rates go down, there should be a collective release of happiness, I suppose.
Largely, people's biggest borrowing is typically a mortgage. And here in Cayman, a lot of those mortgages are tied to variable rates. Or if there's a fixed rate, it's usually for a short term, maybe 1 year, 3 year, 5 year. In the U.S., the standard really is to lock in a fixed term for 30 years. So that's a much different perspective. So the inter-year changes of rates aren't going to impact that monthly mortgage payment that you have in the U.S., but here in Cayman, it certainly can. So if you're on a variable rate mortgage, you're going to see a change in your payment reflected in the next month or so.
It's slightly ironic, I suppose, where we don't set our own interest rates in Cayman, but we're more impacted by the changes of interest rates than perhaps the country that is actually the setter of interest rates for us is.
It certainly is.
Well, that's a reassuring and happy state of affairs. Talking about central banks, though, I think it's fair to say most countries around the world have gone down the route of independent central banks. What's the theory behind that?
Yeah, so we don't want to see the independence is incredibly important, because when we start to politicize it, we have political candidates coming in every few years, and it's really hard to create stability in the economy if you have the latest political trend or theory kind of pulling on those decisions that are being made with a shorter term focus, versus when you have a purely independent central bank, you can really focus on the longer term, focus on what's best for the economy. And it's hard decisions that they have to make. It's not, raising rates in 2022 as drastically as they did in the U.S. was hard on a lot of people and politically not popular, but it helped bring inflation down. We've seen inflation go from nearly 10% in summer of 2022 down to where we are today, which is much, much closer to the Fed's target of 2%.
It's perhaps noteworthy. We often, we're living today in 2025, and central bank independence has been around in most countries for decades now, and perhaps our memories are a little short as to what things were like before independence. I remember in the UK, for instance, there were scenarios where as you went towards an election, the incumbent government, irrespective of the economic conditions, was very often, coincidentally, I'm sure, cutting interest rates leading up to an election. And then straight after an election, by remarkable coincidence, again, interest rates had to go up because they'd engineered a very short-term boost in order to try and encourage people to recognize the value they'd created for the economy and the benefit they'd done by spurring job growth and such like. And that's sort of, I suppose, what we're trying to avoid. We want to have the economy on a fairly even keel for 30, 40 years as opposed to wild fluctuations. And in a sense, it's worked quite well.
It has.
There hasn't been another Great Depression. There hasn't been since the Great Recession. There was obviously one, but that was for various factors. So do you think the theory of central bank independence is here to stay? I mean, there's some political challenges in the US, but in general, do you think it still remains a good theory to keep?
Absolutely. Absolutely, I do. And I think, what we're seeing in the U.S. now kind of questioning that is a bit concerning because it threatens, the freedom of capital markets. And it is incredibly important. And I think many people believe that. I think, kind of across the world, central banks are going to stick to their guns. We've seen the Fed chair in the U.S., Jerome Powell, really stand up to a lot of criticism. And he's been very stoic throughout it. So, I just hope that we continue to have people kind of stand their ground and protect that independence because it's incredibly important.
I guess if you were to think of a characteristic of an economist, stubborn is often top of the list in terms of their perspective. So perhaps that's no bad thing. As many other bad characteristics economists may have, that's certainly one, and it perhaps adds to the credibility of that argument they're making.
Certainly.
So let's talk a little bit about interest rates have been on hold now for a couple of years, basically. Do you what's going to happen there? Because there are people, not everybody, most people who will be listening to this show will have mortgages, as you say, will have credit card debt, will have all sorts of debt products that are burning holes in their pockets, and cost of living here is expensive. So any small improvement is always welcome. Mm-hmm. So are we going to see dramatic changes in interest rates? What's a likely path, do you think, in the US for interest rates?
Yeah, I mean, I think a lot of people, prior to the current administration stepping in and announcing the tariff policies that they have, I think a lot of people had expected rates to fall further in 2025, and we've not had any rate cuts yet this year. We did see a full point at the end of 2024. The Fed itself is still predicting 2 25 basis point rate cuts for the remainder of this year. It's anticipated that they may start that process in September at their next meeting. They're meeting today and tomorrow in Jackson Hole, Wyoming for their annual summit there, where they're actually focusing very closely on the labor market and the labor market transition as they start to look into a deep dive of demographics and the changes that AI will bring to the labor force. But I think it's likely we'll start to see some cuts, but I don't think it's going to be anything drastic. I think they're going to continue to move with a measured pace. The concern that the Fed has had this year and why they haven't cut as yet is because they want to see inflation get down to their target, or at least showing progress that it's on its way there. But with the new tariff policies that have come into play, they didn't want to preemptively cut rates and then have to push them back up again to handle inflation. That's
there's 2 points I want to ask you about. We'll take them in turn. The first will be about tariffs and what sort of. There's been a whole lot of news about tariffs. Whole lot of news about tariffs. They're not happening. Then a whole lot of news about tariffs are happening or sometimes happening or in part. And then on the other side of the coin is the change in the labor force dynamic in the US, because you say that the Fed has this employment mandate. Now, there's a lot of unskilled labor that is being exited the US for immigration policy reasons. So I'm curious as to what your senses those two factors have in terms of tariffs on price levels and then the potentially a diminishing supply of labor, what impact that might have on prices. So take those in whatever turn you wish. But that was sort of the rounded question I wanted to get to.
Yeah. Let's talk about the labor market first and jobs. And as you say, we've seen very limited, if any, immigration incoming to the U.S. This year and a lot of exiting. The last few months of the jobs numbers have been reported and then they've been revised, and they've actually were much weaker than initially reported. And that's just due to a mechanism of how they report and, companies reporting on time and whatnot. And the actual unemployment rate didn't move in conjunction with that. And I think that is kind of an indication of the changing in the labor market and actually the labor supply, if you will. So the data is a little bit messy right now, I think, but we are starting to see a weakening in that labor market, and maybe it's not quite as pronounced through the unemployment rate because of these changes in immigration dynamics. And what was the second question?
Well, the second is about tariffs.
Tariffs, right?
So we've got. But before we go on to tariffs, though,
Sure.
the impact then is. I'm casting my mind back I was going to say a few years, a few decades to supply and demand classes I had taken at school. A lack of supply in terms of labour generally has the potential to force up prices as well, because it means you have to pay more for the labour in order to harvest your oranges or whatever it is that you harvest, the farm products, whatever it is that you do. If there's fewer people available to do that and it's a manual labour job, that has the potential to push up prices.
Absolutely.
So the Fed's going to be looking at that and saying, well, that's a risk, isn't it, to the price level?
Mm-hmm. Absolutely. I think you're spot on there. And there's a lot of these dynamics that the Fed is trying to parse through and piece together and see what flow through we'll actually see. I mean, jumping ahead a little bit, all the tariff announcements and then retractions and announcements and retractions. But the U.S. has started charging tariffs on all goods coming in, and we haven't seen kind of a jump in prices as yet in effect from that. But we recently saw kind of the wholesale prices that businesses are paying for goods jump up, and that's not yet being passed on to consumers. But it's inevitable that it ultimately will to some extent.
I guess if you think about a company, just take an example here in Cayman, ALT, for instance. If lumber prices go up, ALT's got a supply of lumber sitting in its lumber yard, and that price that's there doesn't change because it's already been bought, but the stuff that comes in. So if companies in the US have warehouses of stuff already, the prices aren't going to change until they've sold that stuff, and then they have to buy new stuff from overseas.
Correct. And a lot of companies ahead of, early the first quarter of this year, before the tariffs were announced, had stocked up on goods because they wanted to buy it before any price changes.
Now, I saw an announcement, perhaps it was yesterday or perhaps this morning, perhaps for those with children, a horrible upcoming announcement, but the price of a PlayStation is going to be going up. Sony is responding to tariffs by saying that price is going up by $50, $100 or so dollars, which is a material increase from what's already a fairly expensive product. Has a lot of computing power and the rest of it, but $100 or $150 is a big change, and that's predominantly because of tariffs.
Yeah.
And so that's the sort of thing that potentially we might see. So you're sitting in, well, I'm going to say sitting in the Federal Reserve building. Some dispute about the refurbishment of that building, but we'll leave that to one side. But imagine yourself sitting in the Federal Reserve building and you're looking at all this data and you're saying, well, on the one hand, labour impacts potentially could raise prices. Tariffs, on the other hand, could raise prices. But then equally, price rises are often associated with a slowdown in demand. It can cause recession. So what do you do?
I mean, I think what they have done is they've been patient, and I think they'll continue to be.
I don't think patience is a word that existed in dictionaries today, does it? I thought that was a very old-fashioned sort of thing. The TikTok generation don't understand such things, do they?
It certainly frustrates people.
You've got a young child. How does patience work?
It's no one wants to be patient these days, and I think that's why the Fed has been getting as much criticism as they have this year.
People just aren't used to it, I suppose, and so patience. But you suspect there will be some cuts. A risk of recession as a result of all these other things that are going on, a risk of a downturn. What's your take on that? Because that's always a concern, because Cayman is impacted by such things. People, fewer tourists, fewer financial services activity, and people who are investing. I mean, we talk about that in a short while. What does that mean for people?
Yep. Yeah, I mean, certainly it's a risk. There's factors kind of playing in that direction, and I'm not going to say I definitely think there will be a recession again in the future. Will it be in the near term? Will it be a year or 2 years from now? I'm not in a place to predict that, but we certainly are seeing some risk factors tick up through everything that's happening right now.
Talk to me a little bit about, let's assume interest rates do change at some point. And I say by change, I mean they go down. People have investment portfolios, or people are thinking about putting an investment portfolio together. What does that mean for the different constituents of it? What do they need to know in order to be prepared for that sort of action?
Yeah, I think Diversification is your best friend when you start to think about all of this. Definitely don't want to put all of your eggs into one basket. I'm sure everyone's kind of heard that phrase before. It's important to have exposure to different asset classes, different types of securities, different geographies, and having that kind of helps to, when one sector is hit by something specifically, maybe you've got exposure elsewhere to help balance it out. So you're not taking a massive hit on your portfolio all at once. And that's really kind of how you can weather through different economic periods within your investment portfolio.
Why, though, do, say, equities perform poorly when economies are in difficulty, bonds perform better when interest rates? What's the background to that, or the theory back to that, perhaps?
Yeah, so when interest rates go up, bonds are going to be paying out a higher amount of yield, and they tend to fare a little bit better through those periods. Stocks, when the cost of borrowing goes up, that's the same thing for companies as it is for individuals. The cost of capital goes up for companies. So as they're making capital allocation decisions, deciding whether to invest in a new project or a new building, then all of these things cost more money for that company, and they're going to have to discount their future earnings by that higher rate as well. So theoretically, their earnings won't be quite as high, and the stock prices will adjust to reflect that. But that being said, the stock market is very much looking into the future, so they start to discount things or give premiums to things well in advance of it actually happening. So I would say that's certainly not the only factor impacting stock prices.
It's always confused me in so many respects, because you see interest rates being cut and there's a short-term euphoria often. Markets get excited by this. And that's typically the path that happens. And then a few days, few weeks, or maybe sometimes even a few hours later, people start to say, well, hang on, why are interest rates being cut? Well, they're being cut because potentially we might be going into a recession, or things might be getting worse. Well, that's bad news. Mm-hmm. And so then things go the other way. It's not easy to navigate, right?
Certainly not.
So diversification by asset class, by geography. Mm-hmm. What would you, when you think of diversification, are there any good rules of thumbs in terms of percent that you should have in equities versus bonds versus geographies? Are there any concentration limits that you try to get people to avoid? 100% obviously wouldn't be diversified in something, but what sort of guardrails do you give people?
Certainly, yeah. I mean, it really is kind of dependent on the individual person, their stage of life, their long-term goals, time horizon, that sort of thing, which can kind of drive the equity versus bond exposure. We typically say into kind of different alternative type of asset classes, maybe not more than 15 to 20% of your overall portfolio. But with equity exposure, there's really a lot of factors to the individual that matter more than just kind of a set guardrail, I would say. And
then talking equity exposure, there's so many different styles of equity investing. And I'm genuinely curious as to what your style, philosophy, approach is, because no one is right or wrong as such, but there's just different perspectives. So talk to me a little bit about what your perspective as an investment manager is when you talk with your clients as to the style that you generally recommend.
Yeah, so we manage money for the long term. We manage fully diversified portfolios across asset classes. When we're looking at equities, specifically, we are looking for companies that have shown a track record of profitability, financial strength. They have factors that make it difficult for competing firms to come in and take market share from them. Really, all of these kind of high quality factors is our focus.
But then someone comes to you and say, but will I be owning NVIDIA? Because that seems to be what everyone wants to own right now. So how do you respond to that? All I want to know is, do you own NVIDIA, right?
We do buy growth companies as well. So we have exposure across sectors. And we look for companies like an NVIDIA. Full disclosure, we hold NVIDIA in personal and client accounts and have for quite a long time. But NVIDIA is a great story in that it has kind of opened up a new trajectory of growth through this AI boom. prior to the whole AI mania, NVIDIA was really known for having kind of those cutting edge chips for video game graphics.
Don't know why you're looking at me when you're saying video games, but carry on. There's no one else in the studio. We'll go with that.
So we're certainly buying growth companies. I would say not companies that are unproven, but companies that have a nice growth trajectory, good profit margins, and have a new avenue to gain market share.
I'm sort of hearing you're not trying to find the bet on one or two spectacular opportunities which could equally go terribly badly wrong. You're trying to find good long-term steady companies in that sense. Exactly.
Yeah, our holding period is for the longer term, so we buy a stock with the intention of holding it at least 3 to 5 years, sometimes longer. And we've built out the portfolio so we have exposure across all sectors to help weather through the different periods.
When I look at equity markets the last couple of years, they've been relatively well, there was a period just after the election when things went a little bit sideways, but they've been relatively good. Mm-hmm. We haven't had a period of mass panic for a little while. What do you say, though? And I'm not suggesting there is one right round the corner, but there's always seems to be some risk of one being around. And when there is one, how do you persuade clients to sort of close their eyes and ears to that panic and just stay the course? What do you say to them?
I think the best way that we handle that is that we have the conversations with clients up front. So we are very straightforward about how we manage money, how we look at these things, what we're going to do when we get to that next period of market panic. The most recent one we saw was in 2022, and we saw both stocks and bonds kind of going down at the same time, which is very unusual. So it's having those conversations up front. We go through with investor profiles and get an understanding of clients' risk tolerance and how clients may react to market periods like that. So we know who we need to be proactive with and having conversations with. And we just try to be very transparent in our thinking and our intentions to stay fully invested through these periods. We know that in the long run, we can manage through them. We've built the portfolio for that. And it can feel uncomfortable when you're in the midst of it, for sure. And we fortunately have built that relationship with our clients to weather through.
Well, talking about listening to clients, and we've only got a couple of minutes, literally 2 minutes left in the show, but I don't want to end the show without talking about financial literacy, because educating your clients or listening to your clients is one thing, but you're talking about financial literacy earlier in life. And talk to me a little bit about what that's about with you.
Yeah, so this is a little bit of a passion project for me. I've been exploring different ways to get more financial literacy information out there. And I am one person, so I can only go and do so many school visits to talk to high schoolers and whatnot. But I've taken the route of creating a recommended reading list of books for kids, for children, for young children, for parents to read with their kids, and then created a set of reading guides to go along with that. So these are just regular stories that happen to have some economic or financial or money terms kind of woven through them. And I think it's tough for people to know where to start with their kids, and you can start from quite a young age. I mean, even age 3 to 5, you can start building those foundational concepts. And the guides basically just kind of go through, give you a summary of the story, the key themes, the key money themes effectively that are woven in. Here are some questions that you can read, that you can ask your child as you're reading through the book, after you've read the book. And then here are some follow-up activities that you can incorporate into day-to-day life with your child and start having those conversations, make them more regular. From ages like 6 to 12, kids are really kind of developing their financial internal philosophy, if you will, and they're picking up habits from your home, from how you manage your money and how you talk about money. And a lot of this is just not spoken about to kids at that age because you don't want to burden them. But it can be really beneficial for them. And then when they get to an older age and they can, they have the numeracy skills to actually start learning about budgeting and those sort of things, this helps build the building blocks for that.
I wonder if there's not flip side, an additional benefit from that is by having a conversation with your child, whether the child understands everything that's been talked about, but you're at least opening a conversation about household finances, which often families don't do a very good job at talking about things, and then suddenly there's a big surprise, and then there's a big argument, and then things get worse. But by having that conversation, opening that conversation improves household transparency in some respects.
Absolutely. And that exposure is so good for kids. And then when they get to teenage years and they have the ability to actually start making these decisions, it's important to give them the autonomy to do so. And you have to let them make mistakes in it. And obviously it's still a controlled environment. They're still at home with you, and it's not going to be something devastating, versus if the first time they're making these decisions is when they're adults out in the world, then those results can be a bit more devastating.
Yeah, being an adult is a devastating thing. I totally agree. That's a different story. We are almost out of time. Where would we find these reading lists that you talked about? They're on your website, I presume.
They are on our website, yeah. So www.radixfinancial.com. Go into the market insights section and you'll find them there.
Terrific. Well, Jessica, we are, as I say, out of time. Thank you for joining Money Sense this morning. It's been a real pleasure and enlightening conversation. I appreciate your time and your candor on the show this morning.
Absolutely. Thank you for having me.
Absolute pleasure. I hope it's the first of many visits in the future. Finally, as a quick reminder, as we always do, our shows can be found on YouTube. Type Money Sense Cayman. And those with topics you wish us to cover, simply send us an email to moneysense@cfacayman.ky. With all that said, remains simply to say thank you for tuning in, and do rejoin us again in 2 weeks' time.